Welcome to this safe MLO license exam review, covering the core areas you need to know. Brought to you by Birdsey, your AI study partner that simplifies mortgage concepts and helps you pass with confidence. In this video, we'll cover federal mortgage-related laws, general mortgage knowledge, and loan origination and ethics. Be sure to like and subscribe for more exam prep, and don't miss what's happening in the lower corner. It could be key to passing your exam. Let's get started.
Federal mortgage-related laws. Truth in Lending Act, HOEPA, and right of rescission. What is the primary purpose of the Truth in Lending Act? Is it A, to ensure consumers are informed about credit terms and costs? B, to regulate interest rates on mortgages? C, to provide insurance for mortgage loans? Or D, to set minimum down payment requirements? The answer is A, to ensure consumers are informed about credit terms and costs. TILA aims to promote informed use of consumer credit by requiring disclosures about terms and costs. It ensures consumers understand their financial obligations. Under the Home Ownership and Equity Protection Act, what triggers a loan to be classified as a high-cost mortgage? Is it A, the loan has a term of less than 10 years? B, the loan's APR exceeds the average prime offer rate by a specified percentage? C, the borrower has a credit score below 600? Or D, the loan is for a second home? The answer is B, the loan's APR exceeds the average prime offer rate by a specified percentage. A loan is high cost if it exceeds certain APR thresholds or has excessive fees. HOEPA protects consumers from predatory lending.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is the duration of the right of rescission period under TILA for a refinance transaction? Is it A, 1 business day? B, 2 business days? C, 3 business days? Or D, 5 business days? The answer is C, 3 business days. The right of rescission allows borrowers to cancel certain transactions within 3 business days, providing a cooling-off period. A borrower refinances their home mortgage and later decides to cancel the transaction. How long do they have to exercise their right of rescission? Is it A, 3 business days? B, 1 business day? C, 5 business days? Or D, 7 business days? The answer is A, 3 business days. In refinance transactions, borrowers have 3 business days to rescind the agreement, allowing time to reconsider the decision. Which of the following transactions is not subject to the right of rescission under TILA? Is it A, home equity line of credit? B, refinance of a primary residence? C, home improvement loan? Or D, purchase money mortgage? The answer is D, purchase money mortgage. Why this question may seem a bit tricky. The right of rescission applies to certain transactions, but not all. It does not apply to purchase money mortgages. What is the primary purpose of the Home Ownership and Equity Protection Act? Is it A, to provide tax benefits for homeowners? B, to protect consumers from predatory lending practices? C, to regulate interest rates on all mortgages? Or D, to ensure all lenders offer the same loan terms? The answer is B, to protect consumers from predatory lending practices. HOEPA is designed to protect consumers from predatory lending practices by imposing restrictions on high-cost loans and requiring additional disclosures. A borrower is refinancing their primary residence and receives the necessary disclosures. How long do they have to rescind the transaction under TILA? Is it A, 1 business day, B, 2 business days, C, 3 business days, or D, 5 business days? The answer is C, 3 business days. The right of rescission under TILA allows borrowers 3 business days to cancel a refinance transaction on their primary residence after receiving the disclosures. Real Estate Settlement Procedures Act disclosures and prohibitions. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to ensure consumers receive disclosures about settlement costs, B, to regulate interest rates on mortgages, C, to provide tax benefits for homebuyers, or D, to enforce building codes? The answer is A, to ensure consumers receive disclosures about settlement costs. RESPA aims to protect consumers by ensuring they receive disclosures about the costs of real estate settlements and prohibiting certain practices that increase settlement costs. Which document must lenders provide to borrowers within 3 business days of receiving a loan application under RESPA? Is it A, closing disclosure, B, loan estimate, C, annual escrow statement, or D, servicing transfer statement? The answer is B, loan estimate. The loan estimate provides borrowers with important information about the loan terms and estimated costs. A borrower receives a loan estimate and notices a fee for a service they did not request. What should the borrower do according to RESPA? Is it A, ignore the fee as it is standard practice, B, pay the fee to avoid delays, C, question the fee and request its removal, or D, contact the Consumer Financial Protection Bureau immediately? The answer is C, question the fee and request its removal. RESPA prohibits charging for unrequested services. The borrower should question the fee and request its removal.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Under RESPA, which of the following practices is prohibited? Is it A, providing a loan estimate, B, charging for credit reports, C, offering discounts for bundled services, or D, receiving kickbacks for referrals? The answer is D, receiving kickbacks for referrals. Kickbacks and referral fees that increase settlement costs are prohibited under RESPA to protect consumers. Which of the following is not a requirement under RESPA for mortgage lenders? Is it A, providing a loan estimate within 3 business days, B, offering a fixed interest rate, C, disclosing affiliated business arrangements, or D, providing a closing disclosure 3 days before closing? The answer is B, offering a fixed interest rate. Why this question may seem a bit tricky, the options include practices that are commonly misunderstood as RESPA requirements. Under RESPA, what is the maximum amount a lender can require a borrower to deposit into an escrow account for taxes and insurance at closing? Is it A, 1 month of escrow payments, B, 2 months of escrow payments, C, 3 months of escrow payments, or D, 4 months of escrow payments? The answer is B, 2 months of escrow payments. RESPA limits the amount a lender can require for escrow accounts to ensure borrowers are not overcharged. The limit is 2 months of escrow payments at closing. A borrower is reviewing their closing disclosure and notices a fee labeled as processing fee that was not on the loan estimate. What should the borrower do according to RESPA? Is it A, ignore the fee as it is likely an oversight, B, Accept the fee as part of the closing process. C. Ask the lender for clarification about the fee. Or D. Contact a real estate attorney immediately. The answer is C. Ask the lender for clarification about the fee. RESPA requires that the closing disclosure reflects the loan estimate unless valid changes occur. The borrower should ask the lender for clarification about the fee. ECOA, HMDA, FCRA, GLBA, and other federal consumer protections. What is the primary purpose of the Home Mortgage Disclosure Act? Is it A, to ensure transparency in mortgage lending and prevent discrimination? B, to regulate the interest rates on mortgage loans? C, to provide tax benefits to first-time homebuyers? Or D, to establish minimum down payment requirements for mortgages? The answer is A, to ensure transparency in mortgage lending and prevent discrimination. HMDA requires financial institutions to report data about mortgage applications to ensure transparency and prevent discriminatory lending practices. A lender receives a mortgage application from a couple and notices the applicant's race is not indicated. What should the lender do according to ECOA? Is it A, reject the application until the information is provided? B, estimate the applicant's race based on visual observation? C, proceed with the application without the information? Or D, require the applicant to submit the information before processing? The answer is C, proceed with the application without the information. ECOA requires lenders to request information on race, ethnicity, and sex for monitoring purposes, but applicants are not required to provide it. Under the Fair Credit Reporting Act, how long can negative information remain on a consumer's credit report? Is it A, 5 years, B, 7 years, C, 10 years, or D, indefinitely? The answer is B, 7 years. Most negative information can remain on a credit report for up to 7 years, with some exceptions like bankruptcy. Which federal law requires financial institutions to develop a written information security plan to protect customer information? Is it A, Fair Credit Reporting Act, B, Equal Credit Opportunity Act, C, Home Mortgage Disclosure Act, or D, Gramm-Leach-Bliley Act? The answer is D, Gramm-Leach-Bliley Act. Why this question may seem a bit tricky. The Gramm-Leach-Bliley Act is often confused with other privacy laws, but it specifically mandates security plans. What does the Equal Credit Opportunity Act prohibit lenders from considering when evaluating a credit application? Is it A, credit score, B, income level, C, race or national origin, or D, employment history? The answer is C, race or national origin. ECOA prohibits discrimination based on race, color, religion, national origin, sex, marital status, or age. Under the Gramm-Leach-Bliley Act, which of the following is not considered a requirement for financial institutions to protect consumer information? Is it A, develop a written information security plan, B, limit data sharing with non-affiliated third parties, C, obtain consumer consent for all data sharing, or D, inform consumers about privacy policies? The answer is C, obtain consumer consent for all data sharing. Why this question may seem a bit tricky. The GLBA requires financial institutions to develop a written security plan, limit data sharing, and inform consumers about privacy policies. However, it does not mandate consumer consent for all data sharing. General mortgage knowledge. Mortgage loan products and features: fixed, ARM, FHA, VA, USDA, conventional. What is the primary benefit of a fixed-rate mortgage? Is it A, consistent monthly payments, B, lower initial interest rates, C, no down payment required, or D, flexible payment options? The answer is A, consistent monthly payments. A fixed-rate mortgage offers stability with consistent monthly payments, making it easier for borrowers to budget over the life of the loan. Which type of mortgage is specifically designed for rural property buyers? Is it A, FHA loan, B, VA loan, C, USDA loan, or D, conventional loan? The answer is C, USDA loan. USDA loans are intended for rural property buyers and offer benefits with no down payment requirements. What is a characteristic of an adjustable rate mortgage? Is it A, interest rate remains constant, B, interest rate can change over time, C, guaranteed no prepayment penalty, or D, always requires a 20% down payment? The answer is B, interest rate can change over time. ARMs have interest rates that can change periodically, affecting monthly payments. A veteran is looking to purchase a home with no down payment. Which mortgage option should they consider? Is it A, conventional loan, B, FHA loan, C, USDA loan, or D, VA loan? The answer is D, VA loan. VA loans are available to eligible veterans and often require no down payment, making them an attractive option for veterans. Which mortgage type might initially offer lower payments but could increase significantly over time? Is it A, fixed-rate mortgage, B, FHA loan, C, adjustable-rate mortgage, or D, VA loan? The answer is C, adjustable rate mortgage. Why this question may seem a bit tricky. ARMs can start with lower payments, but their rates can increase, unlike fixed-rate loans, which remain constant. Which mortgage type might require private mortgage insurance if the down payment is less than 20%? Is it A, VA loan, B, USDA loan, C, conventional loan, or D, FHA loan? The answer is C, conventional loan. Why this question may seem a bit tricky. PMI is typically associated with conventional loans when the down payment is less than 20%. Other loan types, like FHA, have different insurance requirements. Primary versus secondary markets, lenders and investors. What is the primary function of the secondary mortgage market? Is it A, to provide liquidity to lenders, B, to originate new loans, C, to set interest rates for mortgages, or D, to insure mortgage loans? The answer is A, to provide liquidity to lenders. The secondary mortgage market provides liquidity to lenders by allowing them to sell loans, freeing up capital to issue more loans. Which entity is primarily involved in the secondary mortgage market? Is it A, Federal Housing Administration, B, Fannie Mae, C, Department of Veterans Affairs, or D, Consumer Financial Protection Bureau? The answer is B, Fannie Mae. Fannie Mae is a major player in the secondary mortgage market, purchasing loans from lenders to provide liquidity. A lender sells a bundle of mortgages to an investor. What is the primary benefit of this transaction for the lender? Is it A, to increase interest rates, B, to reduce loan origination costs, C, to free up capital for new loans, or D, to improve customer service? The answer is C, to free up capital for new loans. Selling mortgages allows the lender to free up capital, enabling them to issue more loans and maintain liquidity. Which of the following is a characteristic of the primary mortgage market? Is it A, securitization of loans, B, trading of mortgage-backed securities, C, providing insurance for loans, or D, origination of loans to borrowers? The answer is D, origination of loans to borrowers. The primary mortgage market involves the origination of loans directly to borrowers by lenders. In the context of mortgage markets, what role does Ginnie Mae primarily play? Is it A, buying loans from lenders, B, guaranteeing mortgage-backed securities, C, setting mortgage interest rates, or D, insuring mortgage loans? The answer is B, guaranteeing mortgage-backed securities. Why this question may seem a bit tricky. Ginnie Mae guarantees mortgage-backed securities, which might be confused with buying loans like Fannie Mae. In the mortgage market, which entity is primarily responsible for providing liquidity by purchasing loans from lenders? Is it A, retail banks, B, credit unions, C, Fannie Mae, or D, mortgage brokers? The answer is C, Fannie Mae. Why this question may seem a bit tricky. The term liquidity might lead some to think of banks, but in the mortgage market, entities like Fannie Mae and Freddie Mac are key in purchasing loans to provide liquidity.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Basic mortgage terminology and concepts. What is the primary purpose of a mortgage? Is it A, to secure a loan for purchasing real estate, B, to insure a property against damage, C, to increase the property's market value, or D, to provide tax benefits to homeowners? The answer is A, to secure a loan for purchasing real estate. A mortgage is primarily used to secure a loan for purchasing real estate, with the property serving as collateral. What does LTV stand for in mortgage terminology? Is it A, loan to venture, B, loan to value, C, lease to value, or D, loan to volume? The answer is B, loan to value. LTV stands for loan to value ratio, which compares the loan amount to the appraised value of the property. Which term describes the interest rate that remains constant throughout the life of the loan? Is it A, variable rate, B, adjustable rate, C, fixed rate, or D, hybrid rate? The answer is C, fixed rate. A fixed-rate mortgage has an interest rate that does not change over the loan term. A borrower is considering a mortgage with a 5% interest rate and a 20-year term. What type of mortgage is this if the rate does not change? Is it A, adjustable rate mortgage, B, interest-only mortgage, C, balloon mortgage, or D, fixed-rate mortgage? The answer is D, fixed-rate mortgage. This is a fixed-rate mortgage because the interest rate remains constant throughout the 20-year term. In mortgage terms, what does amortization refer to? Is it A, paying only the interest on a loan, B, gradual reduction of a loan balance through regular payments, C, increasing the loan balance over time, or D, paying off the principal in a lump sum? The answer is B, gradual reduction of a loan balance through regular payments. Why this question may seem a bit tricky. Amortization involves both principal and interest payments, not just interest or principal alone. Mortgage loan origination activities. Application process, disclosures, and borrower qualification. What is the primary purpose of the loan estimate in the mortgage application process? Is it A, to finalize the loan terms, B, To provide an estimate of loan costs and terms. C. To verify the borrower's income. Or D. To lock in the interest rate. The answer is B. To provide an estimate of loan costs and terms. The loan estimate provides borrowers with important details about their loan, including estimated interest rates, monthly payments, and closing costs, helping them understand and compare loan offers. Which document is used to inform the borrower of their right to receive a copy of the appraisal report? Is it A. Loan estimate, B. Closing disclosure, C. Notice of right to receive copy of appraisal, or D. Good faith estimate? The answer is C. Notice of right to receive copy of appraisal. The notice of right to receive copy of appraisal informs borrowers they can receive a copy of the appraisal report used in the loan decision. What is the maximum allowable debt-to-income ratio for a qualified mortgage under the ability to repay rule? Is it A. 43%, B. 36%, C. 50%, or D. 28%? The answer is A. 43%. The ability to repay rule sets a maximum DTI ratio of 43% for a loan to be considered a qualified mortgage. A borrower is applying for a mortgage and has a credit score of 680. What is the likely impact of this score on their loan application? Is it A. The application will be rejected, B. The borrower will receive the lowest interest rate, C. The borrower will need a cosigner, or D. The borrower may face higher interest rates? The answer is D. The borrower may face higher interest rates. A credit score of 680 is considered fair to good, which may result in higher interest rates compared to higher scores, but is generally acceptable for loan approval. Which of the following is not typically considered when calculating a borrower's debt-to-income ratio? Is it A. Car loan payments, B. Utility bills, C. Credit card payments, or D. Mortgage payments? The answer is B. Utility bills. Why this question may seem a bit tricky. Some might assume all regular expenses are included, but utilities are not typically factored into the DTI ratio. What is the primary purpose of the closing disclosure in the mortgage application process? Is it A. To estimate the loan costs, B. To provide final loan details, C. To verify the borrower's income, or D. To inform about the appraisal process? The answer is B. To provide final loan details. The closing disclosure provides the borrower with the final details about the mortgage loan, including loan terms, projected monthly payments, and closing costs. A borrower receives a loan estimate and notices a significant increase in the estimated closing costs compared to initial discussions. What should the borrower do next? Is it A. Ignore the changes and proceed, B. Cancel the loan application, C. Discuss discrepancies with the lender, or D. Contact a real estate agent? The answer is C. Discuss discrepancies with the lender. The borrower should review the loan estimate carefully and discuss any discrepancies or concerns with the lender to understand the reasons for the changes. What is typically required from a borrower to verify their employment during the mortgage application process? Is it A. Recent pay stub, B. Bank statement, C. Credit report, or D. Tax return? The answer is A. Recent pay stub. Why this question may seem a bit tricky. Employment verification can involve multiple documents, but a recent pay stub is the most direct and common form of verification. Underwriting basics: credit, capacity, collateral, capital. What is the primary purpose of evaluating a borrower's credit score during the underwriting process? Is it A. To assess the borrower's creditworthiness, B. To determine the property's value. C. To verify the borrower's employment history. Or D. To calculate the loan's interest rate. The answer is A. To assess the borrower's creditworthiness. A credit score helps lenders assess the risk of lending to a borrower by indicating their creditworthiness based on past financial behavior. Which of the following is considered when evaluating a borrower's capacity in the underwriting process? Is it A. Credit score, B. Income stability, C. Property appraisal, or D. Down payment amount? The answer is B. Income stability. Capacity refers to the borrower's ability to repay the loan, often assessed through income and employment stability. In mortgage underwriting, what does collateral primarily refer to? Is it A. The borrower's income, B. The borrower's credit history, C. The property being financed, or D. The borrower's savings? The answer is C. The property being financed. Collateral refers to the property being purchased, which secures the loan and can be repossessed if the borrower defaults. A borrower with a stable job and high income applies for a mortgage but has a low credit score. What underwriting factor might still support loan approval? Is it A. Collateral value, B. Down payment size, C. Employment history, or D. Income stability? The answer is D. Income stability. High income and stable employment can indicate strong capacity, potentially offsetting a low credit score in the underwriting decision. Which factor is least likely to be directly influenced by a borrower's recent job change? Is it A. Capacity, B. Collateral, C. Credit, or D. Capital? The answer is B. Collateral. Why this question may seem a bit tricky, a recent job change can affect capacity and credit, but not directly impact the collateral, which is the property itself. What is the primary consideration when assessing a borrower's capacity during the underwriting process? Is it A. Income and employment stability, B. Credit score, C. Property value, or D. Down payment amount? The answer is A. Income and employment stability. Capacity refers to the borrower's ability to repay the loan, primarily assessed through income and employment stability. A borrower with a high credit score and significant savings applies for a mortgage. What aspect of underwriting might still pose a challenge if they have recently changed jobs? Is it A. Creditworthiness, B. Collateral value, C. Employment stability, or D. Down payment adequacy? The answer is C. Employment stability. Employment stability is a key part of assessing capacity, and a recent job change can raise concerns about income consistency.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
In mortgage underwriting, which factor is directly related to the borrower's financial reserves? Is it A. Credit score, B. Collateral, C. Income stability, or D. Capital? The answer is D. Capital. Why this question may seem a bit tricky. Financial reserves are often confused with income, but they specifically relate to the borrower's capital. Closing process, settlement, and loan servicing basics. What is the primary purpose of a closing disclosure in the mortgage loan process? Is it A. To estimate the loan costs, B. To detail final loan terms and costs, C. To verify the borrower's income, or D. To appraise the property value? The answer is B. To detail final loan terms and costs. The closing disclosure provides a detailed account of the final loan terms and closing costs ensuring transparency for the borrower. Which document is typically used to transfer ownership of a property at closing? Is it A, promissory note, B, closing disclosure, C, deed, or D, title insurance policy? The answer is C, deed. A deed is the legal document that transfers property ownership from the seller to the buyer. What is the role of an escrow account in mortgage loan servicing? Is it A, to collect and pay taxes and insurance, B, to manage loan interest rates, C, to handle loan origination fees, or D, to process loan applications? The answer is A, to collect and pay taxes and insurance. Escrow accounts are used to collect and pay property taxes and insurance premiums on behalf of the borrower. A borrower notices a discrepancy in the closing disclosure compared to the loan estimate. What should they do before closing? Is it A, ignore it and proceed, B, sign the documents immediately, C, contact the title company, or D, discuss with the lender? The answer is D, discuss with the lender. Borrowers should address discrepancies with their lender to ensure all terms are understood and agreed upon before closing. Which party is responsible for ensuring that the closing disclosure is received by the borrower at least 3 business days before closing? Is it A, the borrower, B, a lender, C, the real estate agent, or D, the closing agent? The answer is B, the lender. Why this question may seem a bit tricky. The lender, not the borrower or closing agent, is responsible for ensuring timely delivery of the closing disclosure. What is the primary function of a title insurance policy in the mortgage closing process? Is it A, to provide a loan estimate to the borrower, B, to protect against financial loss from title defects, C, to appraise the property's market value, or D, to ensure the borrower receives the closing disclosure? The answer is B, to protect against financial loss from title defects. Title insurance protects lenders and buyers from financial loss due to defects in a property's title. It ensures the title is clear of liens or disputes. A borrower is reviewing their closing disclosure and notices an unexpected fee labeled recording fee. What is the purpose of this fee? Is it A, to pay for the lender's administrative costs, B, to cover the cost of the title insurance policy, C, to officially record the mortgage and deed, or D, to compensate the real estate agent? The answer is C, to officially record the mortgage and deed. Recording fees cover the cost of officially recording the mortgage and deed with the local government, ensuring public record accuracy. Ethics. Ethical responsibilities and consumer protection. What is the primary purpose of the Truth in Lending Act? Is it A, to ensure consumers are informed about credit terms and costs, B, to regulate interest rates on loans, C, to provide insurance for mortgage loans, or D, to enforce fair lending practices? The answer is A, to ensure consumers are informed about credit terms and costs. The Truth in Lending Act is designed to promote informed use of consumer credit by requiring disclosures about terms and costs. It aims to protect consumers from unfair credit practices. Which federal law requires lenders to provide a loan estimate within 3 business days of receiving a mortgage application? Is it A, Truth in Lending Act, B, Real Estate Settlement Procedures Act, C, Equal Credit Opportunity Act, or D, Home Mortgage Disclosure Act? The answer is B, Real Estate Settlement Procedures Act. The Real Estate Settlement Procedures Act requires lenders to provide a loan estimate within 3 business days to ensure borrowers understand the terms and costs. What is the main goal of the Equal Credit Opportunity Act? Is it A, to regulate interest rates on loans? B, to ensure transparency in loan terms? C, to prevent discrimination in credit transactions? Or D, to provide financial education to consumers? The answer is C, to prevent discrimination in credit transactions. The ECOA aims to prevent discrimination in credit transactions based on race, color, religion, national origin, sex, marital status, or age. A borrower receives a loan estimate with terms they do not understand. What should the lender do to fulfill their ethical responsibilities? Is it A, ignore the borrower's confusion and proceed? B, refer the borrower to a financial advisor? C, provide a written explanation only? Or D, explain the terms clearly and answer questions? The answer is D, explain the terms clearly and answer questions. Lenders have an ethical responsibility to ensure borrowers understand loan terms. They should provide clear explanations and answer any questions the borrower has. Which act requires lenders to provide borrowers with a closing disclosure at least 3 business days before closing? Is it A, Equal Credit Opportunity Act? B, TILA RESPA Integrated Disclosure Rule? C, Home Mortgage Disclosure Act? Or D, Fair Credit Reporting Act? The answer is B, TILA RESPA Integrated Disclosure Rule. Why this question may seem a bit tricky, the closing disclosure requirement is part of the TILA RESPA Integrated Disclosure Rule, which combines elements of both TILA and RESPA. Fraud prevention, red flags, and fair lending practices. What is a common red flag indicating potential mortgage fraud? Is it A, unexplained increase in income? B, consistent employment history? C, low debt-to-income ratio? Or D, high credit score? The answer is A, unexplained increase in income. A sudden increase in the borrower's income without a clear explanation can indicate potential fraud, as it may be fabricated to qualify for a loan. Which practice is essential to ensure fair lending? Is it A, offering loans only to high-income individuals? B, ensuring equal access to credit? C, charging higher interest rates to certain groups? Or D, requiring additional documentation from minority applicants? The answer is B, ensuring equal access to credit. Providing equal access to credit without discrimination is fundamental to fair lending practices, ensuring all applicants are treated fairly. What is the primary goal of the Fair Housing Act? Is it A, to regulate mortgage interest rates? B, to promote homeownership among veterans? C, to prevent discrimination in housing? Or D, to provide subsidies for first-time homebuyers? The answer is C, to prevent discrimination in housing. The Fair Housing Act aims to eliminate discrimination in housing-related transactions, ensuring equal opportunity for all individuals. A loan officer notices that a borrower's application includes a different address than the one on their credit report. What should the loan officer consider? Is it A, ignore the discrepancy? B, approve the loan immediately? C, assume it's a clerical error? Or D, verify the correct address? The answer is D, verify the correct address. Discrepancies in addresses can indicate potential fraud, so the loan officer should verify the correct address to ensure the application's integrity. Which of the following is not considered a red flag for mortgage fraud? Is it A, multiple loan applications in a short period? B, high credit score? C, inconsistent signatures? Or D, unusual property value? The answer is B, high credit score. Why this question may seem a bit tricky? The presence of a high credit score is generally positive and not a red flag, unlike the other options which suggest potential fraud. ethical advertising, steering, and prohibited conduct. What is considered a prohibited practice in advertising for mortgage loan originators? Is it A, misleading advertising, B, using testimonials, C, offering discounts, or D, using social media? The answer is A, misleading advertising. Misleading advertising is prohibited as it can deceive consumers about the terms or conditions of a loan. Which of the following is an example of steering in real estate transactions? Is it A, providing a list of all available properties, B, directing clients to specific neighborhoods based on race, C, offering financial advice, or D, discussing property features? The answer is B, directing clients to specific neighborhoods based on race. Steering involves guiding clients towards or away from certain neighborhoods based on discriminatory factors. What is a key ethical consideration in advertising for mortgage products? Is it A, exclusivity, B, creativity, C, truthfulness, or D, frequency? The answer is C, truthfulness. Truthfulness is crucial to ensure consumers are not misled about the terms and conditions of mortgage products. A mortgage broker is considering using a client's testimonial in an advertisement. What must the broker ensure before using it? Is it A, the client is compensated, B, the testimonial is lengthy, C, the client is anonymous, or D, the testimonial is truthful? The answer is D, the testimonial is truthful. The testimonial must be truthful and not misleading to comply with ethical advertising standards. Which action might seem permissible but is actually considered steering? Is it A, suggesting neighborhoods based on perceived preferences, B, providing a list of all available homes, C, discussing school quality, or D, highlighting property features? The answer is A, suggesting neighborhoods based on perceived preferences. Why this question may seem a bit tricky, steering can be subtle, such as suggesting neighborhoods based on perceived preferences that align with discriminatory factors.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.